The term uncertainty seems to come up again and again these days in conversations about the economy. But beneath that uncertainty, there are potential bright spots. One of them being the Canadian real estate market.
There's a lot of optimism this year, yeah.
That's Tracy Gomes, Senior Vice President of Real Estate Secured Lending at Scotiabank.
I think coming off of a couple of years where it was muted and there was the psychological aspect of the client sort of sitting on the sidelines and waiting, there has been a very general healthy optimism.
One reason for that optimism is lower interest rates. But also some recent regulatory changes have made buying a first home more realistic for many Canadians.
The flick of a switch, you find yourself in a situation where I thought I was going to have to save up for a few more years before I can get it in the market, and all of a sudden you can't.
That's Scotiabank Chief Economist Jean-François Perrault. In this episode, with the spring real estate season right around the corner, he and Tracy will give us the lay of the land when it comes to housing. They'll break down the details on those new regulatory changes and their potential effects, why tariff-related uncertainty may actually hold some good news for prospective homebuyers, how condos and new construction are affecting things, and much more. I'm Stephen Maurice, and this is Perspectives. Tracy, JF, welcome to the show. Great to see you both again.
Thank you, Stephen. Nice to be
Thanks,
here.
Steve.
All right, it's tradition on these real estate episodes that we put our guests on the spot right off the top. So, Tracy, is there a headline you can give us or a quick summary of what the real estate market looks like right now?
Yeah, I would say we're expecting a relatively robust 2025 season for the real estate market and mortgage growth in particular. We believe we'll have some activity this year that's better than it was in 2024. So more optimistic.
Okay, I'll get you to expand on that in a second. JF, what's the headline? What do you see?
I'd agree with that. It's difficult to think of 2025 and not be more optimistic with respect to the real estate market. Rates have come down. Affordability is an issue. Some regulatory changes, all those things suggest that we should be in for a better year if people are not too worried about what's going on in relation to Trump.
Right. Yes, that sort of underlies almost every conversation you have on the economic front these days. We'll put it to the side for now. Tracy, maybe you can expand a little bit on that first answer of yours. What are you seeing? What has changed over the course of the past 6 months? Where's the activity happening, if it's happening in any particular place? Just give us a little bit more of the lay of the land there.
Yeah, I mean, as JF said, interest rates have come down, both fixed and variable rate. We've seen about 200 basis points cut. That certainly helps for clients who are waiting for some certainty on the interest rate path to get back into the market. We expect relatively robust purchases and refinances this year. There have been some stimulative policy measures that took effect, which are positive, both in aggregate as well as in particular for certain segments. The $1 million cap, which was increased, that was lobbied for quite some time, and we're very supportive of that being launched December 15th.
Can you explain that a little bit more?
Yeah, so clients who don't have 20% down payment and want a default insured mortgage before were capped at $1 million. So in areas like Toronto and Vancouver, where house prices are above $1 million, it really took them out of the market completely. Right. And so now this move up to $1.5 million really helps them to be able to put minimum down payment and be able to get into a house that they might have otherwise have chosen at the outskirts of a big city where house prices were slightly below. So we expect this to be positive. It launched December 15th, still early to see what kind of activity, but even in speaking with our default insurers, we've seen some pickup in the over $1 million category, about 5-6% in the last 5 to 8 weeks since it's been in effect. Also 30-year AM extension for default insured, which is positive.
30-year AM?
Yeah. So prior to the change, if you were going with an insured mortgage, you could only go up to 25-year amortization. That has now been extended to 30-year AMs for new construction and first-time home buyers. And so what that means is it's probably in the range of about 100 basis points lower rate on your debt service ratio to qualify. So it gives people who are struggling to afford a big mortgage a little bit more breathing room to get in.
Right. So you can get your mortgage insured for a higher cost house with less of a down payment, and you can amortize your mortgage. In other words, extend the repayment of the mortgage over a longer period.
Which lowers your payments.
Which lowers your payments. So it makes housing somewhat more accessible for people who were kept out of the market before.
Yeah, I would say those would probably have the two biggest impacts on the client market. Another two, which are probably a little bit more marginal, are secondary financing now on insured mortgages, which allow a client to actually refinance, which wasn't possible before. And OSFI also announced the removal of a stress test for straight switches with no additional funds, same term. So those two have come into effect.
Okay, maybe for people not familiar with all those terms, you can just explain that a little bit more. OSFI is the regulator.
OSFI is the regulator.
Banks, and they straight switch. What does that mean?
Straight switch means you have a mortgage at one institution, you're looking to shop around and switch your mortgage to another institution at maturity. And you do so without adding any additional funds or changing the amortization of that mortgage. So it's basically just moving that mortgage as is with the same conditions over to a new institution. You do have to requalify for the mortgage at the new institution, but the 2% stress test that is currently in effect for all purchases, OSFI removed it as a requirement that they are stating for straight switches.
Okay.
Now, their expectation, though, is still that the banks do stress test the client at an appropriate level within the institution's risk appetite. So it's not that there's no stress test, but OSFI's not mandating the stress test.
So the bank itself decides, or the lender decides what that stress test will be. And again, just for clarity, the 2%, the stress test was a requirement that a person be able to demonstrate that they could continue to finance a mortgage at 2 percentage points of interest rate above what they were contracting at. Is that correct?
Yes.
Okay. So JF, between all those things, these regulatory changes, lower interest rates, as both of you said before, it looks like this should open up the market or make it easier for people to get into the market. What are you seeing from a price point of view, or just more broadly what the industry is looking like at this point?
Well, I mean, it's hard not, and we're setting aside Trump for a moment here, but it's hard not to be optimistic when you look at all these things together, right? We have lower interest rates, significantly lower interest rates that we know have stimulated the rate-sensitive parts of the economy. We see this in home sales, we see this in car sales, we see this in consumption spending. So we know that the economy is responding to those. And of course, housing is very responsive to interest rate changes. And this is occurring in an environment where, affordability is a challenge, but it's also occurring in an environment where there still is this massive gap between supply and demand, right? So, and folks know this. Mm-hmm. So there's an expectation or fear on the part of prospective home buyers that the longer they wait, the more expensive their house is going to be in an environment where it's already a stretch for a lot of folks to buy their place. Yeah. So that puts a little bit of an urgency on the part of some individuals who are like, well, if I wait a little bit too long, then maybe the place that I'm thinking about or the type of place I'm thinking about will be less affordable this summer or later this year. So that's very real. And we saw this play out, say, in early 2023 when the Bank of Canada paused cutting interest rates. And you saw a very significant response because people were like, we expect this. In fact, you saw prices increase very significantly then. Right. We're not seeing that price increase now. We hope we don't see it again. But that layers on top of some of the things that Tracy talked about, particularly on the mortgage qualification rules. So you think of a place like Toronto or Vancouver where the average price is about $1 million. And people have been saving up for that. Prior to December, effectively, if you were trying to buy $1 million house in Toronto, the average price, you needed $200,000 now. Mm-hmm. Mm-hmm. Same in Vancouver. And that, for a lot of households, is years and years and years and years of savings. Sure. The flick of a switch, you find yourself in a situation where I'd only saved up 70 grand, 80 grand, 100 grand, 150 grand. I thought I was going to have to save up for a few more years before I can get it in the market. And all of a sudden you can. So that's coming into effect. Now, obviously, we're not seeing that in any significant way now, as Tracy indicated, in part because it only took effect a little while ago. But in normal circumstances, these kinds of changes, along with a change in amortization lengths, combined with lower interest rates, combined with the supply deficiency, does really suggest that there should be a significant pickup in volume as the year progresses. And prices, of course. And
is there a countervailing force there? I mean, just to talk briefly about changes to immigration, does that somewhat reduce the demand? Are we seeing that at all yet?
We're seeing a bit of a reduction in demand for rents in certain segments. So, there is some downward pressure in some markets on the rental side. Lower immigration over time, of course, means there's a little bit less demand for housing than otherwise would be. Mm-hmm. But that's at the margin, right? I mean, we're still 3 to 4 million units short in Canada relative to what we need. So fine, you have 200,000 or 300,000 less people coming into the country next year relative to what you'd have thought. it helps at the margin, but it's really kind of a drop in the bucket.
Okay.
And when we had permanent residents of 1.5 million over the last few years, we know that immigrants actually are aggressive savers. So they get to where a Canadian would in home buying, like in a much faster period. So you'd think in the medium term that demand's still going to be there.
Yeah.
Okay. And that sort of pressure that JF was talking about, where I guess people are concerned about housing prices continue to go up and so on. What are you hearing on the street among clients, among mortgage brokers? Is there optimism out there? Is there sort of a fear of missing out, of sort of people feeling they need to rush into the market?
Yeah, I'm in the market a lot just through my mortgage business and with our vendors and clients and brokers. There's a lot of optimism this year. Yeah, coming off of a couple of years where it was muted and there was the psychological aspect of the client sort of sitting on the sidelines and waiting. I think there has been a very general healthy optimism. The policy changes certainly in aggregate help as well for consumer sentiment, and we're feeling good that we're going to have some pickup this spring. Obviously, tariffs throw another level of uncertainty in the mortgage business. If a client feels uncertain about their employment, depending on what sector they're employed in, that can obviously play into the psychology of maybe waiting to get a little more certainty if they think there's some risk there. And I think just the broader uncertainty weighs in on how people decide to make a decision to go and put their house for sale or go and look for a house to buy. So,
right.
I think there's just an important qualification to make from a buyer perspective. I think there's reason to be optimistic. Now, when you talk to, say, the developer side of the real estate market, they're pretty gloomy. Mm-hmm. Right. You look at Toronto developers where there's this condo overhang. People are moving into condos. They're trying to liquidate condos that were priced at a much higher price point that the market is supporting now. Same in Vancouver, maybe a couple of other markets. So there's this distinction between the optimism that you can feel in the resale side and the kind of the newish side versus condo developers and what they will say is going on in the market, which is normal from a cyclical perspective, if you think, because the way the market typically operates, following a price correction, following an interest rate increase where developers are hurt, because that's part of what the adjustment mechanism is to higher interest rates, is the resale market's got to pick up, activity improves, prices go up. At some point, folks in the resale market are like, I'm not finding what I want. It's too expensive. I got to go too far out, whatever. And then they turn to the new market. So there is this kind of transition that occurs. But for the time being, the resale market, we think, is going to do reasonably well.
And in spite of that optimism that exists out there, and you think you're going to have certainly a better year than you did last year, Tracy, prices don't seem to be going up at a very fast pace. I get the sense you've been flat-ish over the course of the last few months. Is that your view of the situation? And do you expect that to change as we get into like a spring market traditionally, more people out there buying and so on?
Yeah, I think nationally is one thing to look at house prices, but there's variability across different regions.
Right.
Certainly house prices have increased out west. You see markets like Calgary where you've seen some price appreciation versus Toronto and GVA where it's been the opposite. So I think it's unique to the market.
Yeah, one thing to keep in mind in all of this is, we can be optimistic about the impact of interest rates on demand and the supply-demand imbalance, and that will put upward pressure on prices almost certainly as we go forward. But the reality is that interest rates operate on economic activity with a big lag. And, rates were at 5% a year ago. Policy rate, of course, mortgage rates higher than that. And those are still impacting the market with a bit of a lag. So as you get further and further forward, not only are you dealing with lower interest rates in the short run, but you're fading that impact of higher interest rates in the past, which, of course, again, were designed to slow the rate-sensitive parts of the economy, of which housing is a major recipient of those effects.
Just to talk about the supply side that you were referring to before, from a housing start perspective, because it almost seems like some of that supply issue, everybody was talking about it a year ago or 2 years ago, somewhat has faded into the background. I get a sense now, at least it's not in the headlines as much as it might have been before. Do you have a sense of where we're at in terms of new construction of housing? And you talked about condos. You get the sense there's a glut of condos, at least in a place like Toronto, that people are having trouble selling.
So starts, they're in the 240, 250,000 range, which is not bad, but it's not great either. But they're coming back off of reasonably low numbers, again, because rates were higher and that was designed to depress starts to some extent. So if you look on kind of average over the last 2-3 years, starts have generally slowed where population has exploded. So that imbalance, which was a problem 3-4 years ago, has only gotten worse over the last couple of years, even though we're just seeing a little bit of evidence now that starts are coming back up to a more normalish level. But, to close the gap, you need starts in the 500,000 range, which we've never, ever, ever seen in Canada.
Right.
So it's true. We're talking a little bit less about supply now. I mean, governments are saying they're doing all these things about supply. They're not really having any impact in the short run. They will presumably over some period of time. But people aren't talking about supply now because, they're talking about lower interest rates. They're talking about a range of things that are capturing the attention more than what we've seen drive interest in supply over the last number of years, which is when prices increase very rapidly. People are like, what's government doing about that?
Yeah, but that gap's going to keep putting pressure on prices to go up over time.
Right.
Yeah.
You've talked a lot about the impact of rising and then declining interest rates. Tracy, lots of people renewing mortgages now that they took out during sort of the boom of house buying in the early COVID days. Interest rates are way lower than they were even a year ago. Yet, for many people, it's going to be quite a bit higher than the mortgages that they took out when they first bought. What are you hearing from customers? Obviously, they're happy every time they see the rates go down, but how are people managing with these renewals at a higher rate?
Yeah, you're right, Stephen. That has been a big topic of discussion. Obviously, the term structure in Canada, every 3 to 5 years, your book is sort of rolling over. I think with interest rates having been high and then the big boom through COVID, we have a lot of maturing mortgages coming due this year and next year, and that's an industry thing. At Scotia, more than 50% of our book is coming due up for renewal in the next couple of years. So when you think about clients, and most of them, say, close to 80% of clients for Scotia in particular will be coming off of a lower rate into a higher rate.
Right.
So even though rates have come down, which certainly has mitigated some of the renewal cliff and some risk that we were looking at a year ago, it's certainly better. For most clients, what's on their mind is how much is my payment going to go up? When we look at the aggregate of mortgages coming off the rates that they are into today's new rates, it's about an 8% increase in payment, which is considerably less than, around 20% about a year ago when the rates were 200 basis points higher. But it's still a big jump, right? And so we have seen that clients are managing very prudently through behaviors. Discretionary spending has been coming down. In particular, we see it on the variable rate mortgage clients who are spending 8 to 9% less than they were, obviously to accommodate. They're the ones who, at Scotiabank, the way that our variable rate mortgage works is that it adjusts as the rates go up and down. It adjusts the payment and passes that through to the customer immediately. And so when rates were going up in 2023, we saw that cohort of clients really absorbing that payment shock. And at some point it was, 45, 50% higher than what they originally took. And so we've been able to monitor the behavior, and clients have been adjusting and making do. So we're feeling very good about that, especially for the new cohort coming of fixed rate customers who will see that payment shock.
And are people going back to variable rates?
Yeah, I think in a declining rate environment, obviously when you're contemplating your choices, a variable rate seems more attractive than when you're uncertain if rates are going to go up or not, because the rate will immediately come down. We have been seeing in new applications more interest in the variable rate than 6 months ago. Majority were selecting a 3-year term about 6 months ago, and that's shifted. It's still the majority, but we're seeing 25% of clients choosing a variable rate now. But it really, I would say, depends on the unique situation of the client and should be a discussion point that they have with the advisor just to manage within their own risk tolerance for what makes sense for that client.
Okay. I don't want to force you folks to speculate too much, but with talk of interest rates and everything that's going on with the potential tariff situation and so on, what's your feeling now about the next few months, JF, when it comes to those rates?
Well, there's some good news and some bad news in all the Trump-related uncertainty. One of the bits of good news is that you're probably in a world where rates are going to be a little bit lower than otherwise would be the case. There's more uncertainty. We think it's having some impact on business spending to some extent. Of course, households are a little more worried about, what they're going to do. They're not sure if they're going to have a job in 6 months or not. I mean, those are all fears that people feel. They're exaggerated, but people feel what they feel. So you're probably in a world where there's a little bit lower rates 6 months from now than they are now. Not necessarily dramatically lower, but a little bit lower. So lower borrowing costs. I mean, that seems like a pretty reasonable bet. That being said, rates are lower in part because people are worried.
Yeah.
And if you're worried, you're not necessarily going to run out into the market and make a big ticket purchase. Mm-hmm. So that's kind of how we think about it conceptually. Now, oddly enough, when we look at incoming data, it's a bit of a different story. In December, we created 90,000 jobs in Canada, which is an extremely strong job growth. The limited bits of information we have for January, so we have auto sales for January that came in a couple of days ago. So, people were feeling the stress. February 1st, which was the Trump deadline, much of January was concerned by that. So a big ticket item like autos, where you got to finance that, where you're committing to payments for a long period of time, those rose at an extremely fast pace. Right. So, yeah, there is reason for people to be worried, but we're also seeing those very same people or chunks of those people still taking advantage of lower interest rates or, spending.
Mm-hmm. I think the lower interest rates are certainly going to help the renewal client.
Right.
And then for a client who's thinking about making a purchase, I think that'll depend on that client's situation. If they feel like their employment isn't going to be affected by all of this, then I think this is the right time. As you said, you want to get in before prices start to drive up because prices have been flat, interest rates are low. I think that will spark people coming off the sidelines into the market.
Okay. Well, you might have answered what was going to be my last question to you, which is what should people who are looking to get into the market, looking to buy maybe a first house or move to a bigger house or whatever, what should they be thinking about this spring?
I think the number one question you need to ask is, how much can I afford?
Right.
And that needs to include all other costs that come with home buying, as well as, how much down payment you can afford to put down, especially for a first-time home buyer where there's legal fees and appraisals and property tax and all these other things. So making sure you're sitting down with an advisor to look at what's the all-in cost and what you can afford. I would highly recommend getting a pre-approval before you actually go work with a real estate agent to start looking at homes. Scotiabank, we have 4,000 advisors across our almost 1,000 branch footprint across Canada that they can work with. We also have home financing advisors who are specialists on mortgages that a client can meet with to get a pre-approval and to see how much they can afford, including as well eHome, which is our digital platform. A client can actually go themselves and key in some data points about what they're thinking and actually get a pre-approval within 5 to 10 minutes in a letter form that they can use to start that process. But that would be the number one thing.
Tracy JF, thank you so much for coming. Really appreciate you taking the time.
Thank you, Stephen.
Thanks, Steve.
I've been speaking with Tracy Gomes, Senior Vice President of Real Estate Secured Lending at Scotiabank, as well as Jean-François Perrault, the Chief Economist here at Scotiabank. The Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.